Today, I want to show you an easy supply and demand strategy that a beginner can use and thrive with. And really, I think I've shown this in some way in one of my earlier videos, but today I'm going to try to explain it better, possibly new and improved, as I learn and understand more about what I'm doing, as I fill in more of the nuance in my brain. But basically, the easiest way to trade supply and demand for me when I first started learning the method was to actually use a Fibonacci. And what we do is we want to remove the entire like all the other numbers from the fib that are not 50, 0, and 100. So if I go in my Fibonacci settings, I just have it set like this. Colors don't really matter. And what you want to do is, let's say the market is doing this, it's flat, and then all of a sudden you break out of the top side, right? So if you have your top here, you have your bottom here. We just broke out of the top side right here, right? And then as price starts trending upward, we're just waiting for a pullback, right? And what we want to do is we want to, once we make a new high and start pulling back like this, so let's say that we're over here, right? And we're just waiting. We haven't gotten our break yet. We keep going. Oh, okay, there's our break, but I wouldn't really mark this out yet. It's still too choppy, right? And now we're trending upward. We're kind of leaving. We have a lot of candles just going in one direction. If you draw a trend line, you can just easily mark this out, right? And so now, once we start getting this type of impulse to the downside, what we can do is we can take our Fibonacci and we can take it from the area where the price last impulse before this high was made. So instead of drawing it from down here, you can take the Fibonacci and draw it from this leg, because if you take this leg here, this is its own separate impulse, right? And we hadn't broken structure at that point. So really, I guess the way I should explain it is you want to draw the range with the Fibonacci from the impulse that broke structure. So that would be this impulse starting here to this high here. And now that we're pulling back, we draw it from top to bottom to top. Boop. And here's the fun part. So once you draw this out, what you're saying is that any area of demand under the 50% would be fair game. Basically, you're just looking for your reversal signals within this first area of demand or this area of demand. So I'll mark out the areas of demand that I see, and it's going to get really messy. But basically, you have anywhere down in here where price can bounce. Now that can initially get very confusing, but let's go ahead and see what happens. So I'm going to actually, I didn't mean to do that. I'm going to go down and I'm going to play it out. So now we're in the demand. Now you could take the first bullish engulfing as a trade if you want. Let's see what would happen if we do that. And if you do this, what you're really saying is that this is the end of this move, right? This is not going to move any further. And as long as this area, if you put your stop loss under this area of demand, then basically you're saying that it's going to hold. And this is the last point. So let's see what that trade looks like. It's quite large. I don't like this. But I would say this is the safest stop loss, especially if we're going to maintain trend, because you're protected by this area of demand. If you put it in here, price can actually still retrace down into here some more. With areas of demand, price can go all the way to the back of the throat and then come back up. It can even wick all the way down here and then close within the area of demand with a body. Now that's something you have to watch out for with this early entry. So let's go ahead and play it out and see what happens. So in this case, it does work out, even with the large stop loss. If we had a tighter stop loss like this, then your 1 to 3 would even be just right at the top of this area here. And this is actually the safest take profit, but not the safest stop loss, if that's confusing. The reason this is safe is because when we're pushing up, we expect price to move in a like a staircase, right? So we expect this high to be broken, but we don't know how far it will go. So now let me try to explain this with the full chart showing, and we can actually, this is actually a pretty good trending day. What was this, yesterday? So on US 30. So this is actually pretty good. So now notice this double top here. This sometimes will signal a reversal. So we got in this case, we got our trade from this range to this low to this high, and we took a trade from here because it tapped into this area of demand. But then we got a double top here. So what will happen is we'll just have to sit on our hands and kind of wait. You could take a risky entry from a double top, but that's not the purpose of this video. I just want to show you the range in this video. So now we're waiting, and your new range would be from this low to this high. So your areas of demand would be here, and then we would move this up, and it would be here. So now let's put ourselves back in bar replay, right? We got our double top. We're coming back for the lows we already know. And look, this one just got ran. Full whole body close, no engulfing candle from this area. So we know that we can just delete this box and continue going about our lives. Now we come back down in here. Okay, bam. Look at that. So here's the first engulfing. And we're at the extremes of the range. And we just broke all this structure. So we can take the first entry if we want to. Do this using the same trick. But we already know this loses, right? And that's okay, because no trade is 100%. So let's see what happens here. So we get up, we get a little bit of happiness, and then, oh no, okay, well, they got close, and then we're bouncing. That's nice. That's awesome. Let's see what happens. Okay, a little bit more happiness. Look, we've built this area, but we're consolidating. So this is actually really scary. When we consolidate at a low, there's a lot of times it can run a little bit lower just to clear out all the orders and then continue going. But let's see what happens. And then, oh no, we lost. And then now we just pushed lower. However, a lot of times when you're consolidating like this is pretty bad. You don't want to you probably wouldn't like to be in the trade, because a lot of times price will trend lower, and then what'll happen is that it runs the orders that are it clears out the orders that are in here, and then we continue with the overall thing. But in this situation, we've had one impulse to the top and and then another impulse after a pullback, right? Price likes to move in waves of two most of the time. So we had one impulse up, boom, one impulse up again. We reset with a double top. Now we have one impulse down, pull back, one impulse down. So with that in mind, understanding that we've never actually come back to any of the areas of demand in here, if we start seeing some sort of reversal signals, we could probably take a buy from here. But we already have the almanac, we know what happens. I want to explain the mechanism of why this is happening. We have a larger move that needs to play out. Okay, so now if we keep going, what we can do is we can mark out these areas of demand here, right? But really, like, it gets kind of messy. So in my other videos, I explain that this is a quasi or a head and shoulders on a lower time frame. So really this would be the right shoulder that you're bouncing off of with demand here, and then you have the head of the quasi down here. And really, you can mark it out as one big area, but it's just going to be a giant swimming pool for you to understand like where price is at. But let's see what happens here. We get a nice giant bounce. Now, if you're understanding that this move is now in play here and we haven't bounced into any demand from this move, then you could take this trade, right? You could take this trade and be like, okay, this is going to be a giant run. We understand, we think that it's going to keep going. But if you want to be safe, you don't have to take the trade here. In fact, this is actually a really large candle, but it's really up to you and your risk tolerance, right? Because you're going to have to sit in the trade for a lot longer. And also there's a chance that because it's such a large candle, what I see a lot of times is that price will wick down into here, do some stuff, and then go up. So let's actually see what happens if we took this trade. So we do wick down in here, do some stuff. We're playing around, and now we are finally taking off. And here's the pain of sitting in the trade, right? So you're just kind of like, oh gosh, right? All that being said, though, now that we've broken structure over here, let's get back to our original concept after explaining this reversal here. So we have the break of structure here, and then we have the place where the price started pushing from. So what you're looking for is any area of demand to take a trade from. Now, you have to be aware that we did not break this high up here, so this could actually come all the way back down here and play around, but we don't know. However, according to the rules of the range strategy that we're using, we would just mark out this area of demand and wait for a pullback to it, because it's the first area of demand under 50%. Okay, so we get a pullback into it ever so slightly, maybe not. Okay, there's some space there. So I probably wouldn't take this trade, especially because how large the candle is. So, but this would be an example of where we'd be looking for that pullback to then take another buy. And let's just keep going. So we broke structure again. We have another push out. So once again, we take our fib. We mark out the place where the price started pushing and then up to our new high. And we can trail this if it keeps pushing up. Like for this, I would just drag this here. And really we're looking for a pullback for the first area of demand under 50%. Well, this one is on 50%, so I would take this. Let's see what happens. So we don't get a deep enough pullback. There's too much momentum in the market. And once again, we keep pushing away. So that initial trade that we had set here, which was this one, even though it was ginormous, it would have worked out just now, which is awesome, right? So right now, with this whole explanation, we have pretty much two wins and one loss. So we'd be about, let's see, we have 5R, right? So now let's go and mark out the new place where the price started pushing from before it broke structure, which is this one here. But we don't have any pullback yet, so we can't really like say, hey, this is where we're at. Okay, so here's our pullback. Once again, marking out this new high using the area where we started pushing from. And now we can mark out the first area of demand basically before before 50% or after 50%. See, we're pushing down and we don't get a good enough pullback just yet. Let's see if we get one more. Come on. There we go. So now we're in there. We have the first engulfing we see. Do you want to take this? We can. Let's see what happens. What I'm wanting for one of these to fail, because a lot of times the first engulfing will fail and it keeps running lower, but let's see what happens here. This is I remember this trend being a high trend when we turned on the chart for this video, so let's see. Probably the easiest days to trade this strategy. Okay, so see that first engulfing failed, and a lot of times that'll happen. So really, you just want to wait for another confirmation. Basically, you're looking when this type of thing happens. If you get taken out, what you're looking for is a push down under this, like we have, another push up above a candle, like this, what we have, and then one more pullback with a wick or something, and then basically a push back up. So basically a quasi. You're looking for a head and shoulders. You're looking for something that looks like this, but with candlesticks, like I was talking about earlier. So let's see what happens. Got another push down, but no wick. And look, we just failed. We just failed right through. We just pushed down twice. So that'd be another loss on our books here. And that's okay, because now that zone of demand is invalid. We do have the other one that was under it. But you can also say that, hey, maybe I want to use the head as well, because basically with this whole range trading thing, you can go anywhere under 50% all the way down to the bottom, and that's why we just want to take trades from our areas of demand. The quasis, which let's see if we get one now, are going to be your best bet. So if we get a pullback now, so this was the type of move that I was trying to explain very poorly a second ago. We've got a push down, then a push back up, then a pullback, and then we want a push back up again, like this right here. And this right here would be probably the higher probability entry, because you've given price enough chance to kind of do its thing where it has to make like a V shape and then get out of there. A lot of times you can also see price come back down into here, but I would take an entry off of this, and whether I win or lose, that'd be up to the market. Now, I will tell you here, the safest entry will be under the head of these types of patterns, or under the lowest point. But if you want a tighter stop loss and a higher lot size, you can, and a reason to use a higher lot size, you can put your stop loss, anywhere under this candle. If you think it's going to wick down in here, maybe put it under the point where the missing price would get filled. So in that case, it would be here. But let's see what happens. See if we get taken out by the cruel market again. But usually the quasis are okay. And we start pushing up, and there we go. So we get that one. I don't know if I should be keeping the wins and losses on here, but I'm just using this stuff to illustrate. So in this case, we did have a loss here, and we had it fail on our first, this engulfing right here. And of course, we pushed into the lower zone of demand, right? And then we made our quasi pattern, where I was saying it's classified as a push down like this, then a push up above a red candle, and then another pullback, and then a push up above another red candle. That is really hard to explain, and if anyone finds this, I hope someone asks me in the comments. If it's still confusing, I will try to make a video on quasis. But yeah, that is how I trade that. Anyways, so let's keep going. I'm going to remove these because it gets a little bit messy. Even with all this stuff on the chart, it's still messy. So we'll take our new range from this low to this high. And now, where do we get? Well, we got our area of demand right here. Well, I would probably use this because this is actually under 50%. So taking this candle here as a base. So let's see what happens. We'll wait for the pullback. If we get a pullback, and we pull back right into the area of demand again. Now, this is not an engulfing candle. A lot of times you'll see a lot of momentum in the market, and you don't get an engulfing candle. You get some kind of doji-like candle like this. My suggestion would be that this is, I wouldn't take it, but that is up to your risk tolerance, because what you're going to see a lot of times you'll have a candle like this, then this in the center, and then another impulse candle to the downside. But if you're feeling risky, if you know that this hits this type of strategy hits most of the time, then you can take a trade here. So let's see what would have happened. I'll draw it out just for the risk takers in the world, and I'll put my stop loss under the zone of demand because that is what protects us in our trade. And we'll just go for 1 to 3 like we normally do. And you know what, actually have an idea, because I want to actually mark out what we would have had in trades. So by the end of this video, we can actually see what we got. So let me actually do that, because I think it's very interesting to understand what we're doing here at the end, and what it looks like to have wins and losses with one strategy. So give me 1 second. I don't remember if I removed one in the center over here. I hope I didn't. I don't think I did, because this one was large, so I think we were still in it. Right, because we didn't get a pullback. Yeah, okay, sorry for the segue. Anyways, back to the video over here. So basically we have our area of demand right here, and we'll see what happens. So we keep pushing up, and you know what, it looks like it does work out in this case. So the demand does hold, and we continue pushing higher. Now this is we'll just say based on risk tolerance. I'll say entry based on risk tolerance. But other than that, I think that's okay. I just want to mark that out. This is like, I probably say entry based on enjoying large stop losses. So that's basically what this would be right here. And so we'll just keep going. We'll keep going with the rest of the day. It's about 11 a.m. So this entire area price action was from 7, like an hour after the open. And it was 4 hours of price action. And even with your losses, you would have had, let's see, 2 losses. And you would have had 3, 6, 9, 12. So you would have had 10R through if you just followed this basic strategy here. So let's keep going. Let's see if we can get some more losses in. So now we have a new high again, right? So now we've got this pullback here. This is the area where price started pushing from. And our first area of demand is down here. We'll just keep that marked out for a second. I actually want to keep that marked out because there's something that I have noticed in previous, like when I've been trading this, and I'm hoping it happens here, but I think there's too much upward momentum. And that is the fact that previous range, like how do I explain this? Previous zones of demand that haven't been mitigated. Let's say we I should have wrote this down. So let's say we had a range from here to here. We never got a 50% pullback. Then we have another range from here to here. And let's see what happens, because I need something to fail. So we had the zone of demand here. And let's say that this zone of demand fails, and possibly this zone of demand fails. Well, we already know this one failed, but let's say that both of these fail, and we run back down into this range. Well, a lot of times, the previous 50% can play out. Previous range under 50% can play out. I hope I'm explaining this right. This is very hard to explain. I'm so sorry. I buried the lead on this one. Is that the right? Am I using the right terminology? Ugh. Okay, so this is actually holding, it looks like, so that's unfortunate. I was really hoping for a nice little pullback there. But anyways, let's keep going. So in this case, I would say that this area of demand, it did fail, but it failed with it didn't fail with much momentum, I guess. It popped out of the bottom, popped back in, but at the same time, this is pretty risky I wouldn't usually take this because much like the other one from the other trade, this, I think it was this one here, yeah, I would be expecting at this point this candle, a white candle, and another big red candle down to the lower area, just because of how strong this push came down. I acknowledge that it's in an uptrend, but I would still be expecting one more big bearish push down into here. Well, that's okay. We didn't get it, so we'll keep going. So we haven't had any more 50% pullbacks in this, and now this is the new area where the price started pushing. You can see we broke the high right here. And so now our new area of demand under 50% will be here. And we push back up. So in this case, we could probably use this area here, and we could say that this is a basically a new one here, new area demand. What am I saying? I lost my words, y'all. I lost my words. I think I should end the video. So after this one, basically, I think we've got enough information on this video. My brain is turning into putty after explaining this. So anyways, we're gonna keep going. We could have taken an entry from here if we wanted to keep pressing this range, but one thing you want to observe is that these candles are starting to get really compressed. They're getting really tight. All this price action is very close together now, so this is a little bit more risky, but that is something about that is a little bit of nuance, right? Because that takes a little bit more experience with the eyes. You have to be like, okay, well, we made a new high, but then we started pushing down, we started consolidating, we started going sideways. We did tap on our new demand, but it doesn't look that good because this candle didn't have any momentum in it compared to the red candle. So we can see what happens here though. See, we're still consolidating, or consolidating upwards now, so that's good. And so we did, oh, we almost made it. Oh darn, right? you might have got lucky with spread there. I don't know if spread would work in your favor in that case, but this is a 0.01 micro pip. You could have, if you're watching it, you can just be like, yeah, we take those and just like close it. But otherwise, yeah, that would be one of the things to look out for in this type of situation, where it's like it's pushing up, but it's not a strong push. It's kind of sideways, right? So you want to just be careful about that. So anyways, this has been my TED Talk. Thank you for joining. If you have, I hope you've received value from this. I hope you're having a happy life wherever you are. Till next time.